In this video, we will be continuing on in Chapter 6 in Learning Objective 5, recording inventory system transactions using a perpetual inventory system. In addition to the transactions that we've already covered, there are other inventory transactions that we need to be aware of. The first are freight charges, what is considered freight in, which is shipments from suppliers, and freight out, which is when you ship your inventory to your customers. We will also discuss purchase discounts, discounts offered by the seller to the buyer for quick payment, and purchase returns, when a buyer returns unwanted or defective inventory. So first of all, we'll discuss shipping terms. When goods are shipped, they are shipped with terms either FOB shipping point or FOB destination. FOB stands for free on board and indicates when title or ownership passes from the seller to the buyer. FOB shipping point means that the title passes when the seller ships the inventory. For example, Mario purchased 300 units for $2,700 on April 25th. The terms were FOB shipping point. The inventory was shipped from the supplier's warehouse on April 25th, but did not arrive at Mario's location until April 29th. Using the FOB shipping point, Mario would record the purchase when title passes, April 25th, even though Mario does not have physical possession of the inventory until April 29th. FOB destination is the opposite. FOB destination means title passes when the inventory reaches the buyer's destination. In this example, if the terms were FOB destination, Mario would have waited until the inventory was actually received on April 29th to record the purchase. Freight charges. Freight charges on incoming shipments from suppliers are commonly referred to as freight in. We need to add the cost of freight in to the balance of inventory. Let's say Mario paid $300 for freight charges associated with the purchase of the April 25th inventory. We need to record those inventories as freight costs, as part of the inventory costs. Inventory costs are everything that you pay for the inventory and to get it to you. So to record the $300 freight cost, you would debit inventory for $300 and accounts payable for $300. This is him recording the freight charges. Had he paid the freight in cash, then it will be a credit to cash. Later, when that inventory is sold, those freight charges become a cost of goods sold because they'll be shifted from inventory to cost of goods sold. This is freight in. The cost of freight when you ship your inventory to customers is called freight out. Shipping charges for outgoing inventory are normally reported as operating expenses within selling expenses category on the income statement. So the freight that you pay to receive the inventory goes into inventory. The cost that you pay to ship your items to customers will be a shipping expense. Next, we're going to talk about purchase discounts. As we discussed in Chapter 5, sellers often encourage prompt payment by offering discounts to buyers. From the seller's point of view, these are sales discounts. From the buyer's point of view, they are purchase discounts. Buyers are not required to take purchase discounts, but many find it advantageous to do so. So let's assume that Mario's supplier, Luigi Software, offers the terms 210 net 30 for the April 25th purchase on account, and it is Mario's policy to take advantage of discounts when offered. Do you remember what 210 net 30 means, as we discussed in Chapter 5? As a reminder, 210 net 30. The 2 is your percentage discount if you pay within 10 days. Otherwise, the net or total invoice is due within 30 days. So since Mario is going to take advantage of the discount because he's paying on April the 30th, we need to record the transaction as follows. His original April 25th purchase was for a total of $2,700. So he has an account payable on his books for $2,700 that he needs to take off the books, because once he pays the supplier, he does not owe anything else. So when you're recording this, you need to record a debit to accounts payable for the full balance owed. Then we take the 2% discount. 2% discount on $2,700 is $54. We need to credit inventory for the purchase discount. There is not a purchase discount account. You record it to inventory because when you originally recorded the transaction, you recorded inventory at a higher value than what you actually ended up paying for it. So you need to decrease inventory by the $54 discount. Lastly, cash. This is the amount of cash that you're actually paying to Luigi, which is the $2,700 less your purchase discount of $54. You're actually paying him $2,646. Sometimes companies will find inventory items to be unacceptable for some reason. They're damaged or not what was ordered. In that case, you have a purchase return. In a purchase return, you simply reverse the transaction that you have already recorded. Debit the accounts payable and credit inventory for the amount that you are returning. So let's take a look at the gross profit from Mario's Game Shop after we record these additional inventory transactions. As we know, Mario sold 800 units for $15 a piece, so his total sales revenue is $12,000. Then his cost of goods sold. He sold 100 units out of beginning inventory at a cost of $7, so $700. He sold all 300 from his April 25th between the two different sale transactions. Remember, he sold 200 units on July 17th and then an additional 100 units on December the 15th. Then we said he paid freight charges on that April 25th transaction in the amount of $300. He also took a purchase discount of $54 by paying early within that time period. Lastly, he sold 400 units out of the October 19th purchase when he made the sale on December 15th. So he had a total price there of $4,400. When you take all of these into consideration, notice with the purchase discount, you're subtracting the purchase discount. You get a total of $8,046. That is your total cost of goods sold. Your sales revenue of $12,000 less your total cost of goods sold of $8,046 gives you a gross profit of $3,954.